If you're watching the silver ticker in New York right now, you're looking at 70.15 per ounce. That's the COMEX spot price. That's what mainstream financial media is reporting. That's what your broker's app is showing you. But that price is a lie. While you're watching that number, physical silver is changing hands in Shanghai at 78.30 per ounce. That's not a typo, not a data error, not a temporary spike. That's the actual clearing price for 1,000-ounce bars being delivered in China's free trade zones right now. That's an 8.15 arbitrage gap, the largest divergence between Eastern physical markets and Western paper markets since the Hunt brothers squeeze in 1980. And this gap is doing something the silver market has never seen at this scale. It's creating a physical vacuum that's draining COMEX warehouses, forcing bullion banks into emergency hedging, and breaking the 50-year price suppression mechanism that's kept silver artificially cheap. In the next 27 minutes, I'm going to show you exactly why this gap exists, why it's accelerating, what it means for COMEX delivery capacity, how Eastern buyers are exploiting it for guaranteed profits, and what happens when the paper market in the West finally admits it can no longer dictate the price of a metal it doesn't physically control. This is not a prediction. This is happening right now. The data is public. The flows are documented. The system is breaking in real time. Let's get into it. Let me start with the math, the pure, simple arithmetic that's forcing physical silver to flow east, the arbitrage trade. Here's how the trade works in its simplest form. Step 1, buy silver on COMEX at 70.15 per ounce. Step 2, take physical delivery from COMEX-approved warehouse. Step 3, ship metal to Shanghai. Step 4, sell silver on Shanghai Gold Exchange at 78.30 per ounce. Step 5, collect 8.15 per ounce profit. Now let's add the costs. COMEX delivery costs 0.25 per ounce, warehouse handling, assay documentation, insurance for shipment 0.18 per ounce, all risk coverage, London to Shanghai, freight, air cargo 0.42 per ounce based on 1,000 kilowatt shipment, Shanghai customs and import duty 0.31 per ounce, current 2024 rates, Shanghai Gold Exchange delivery fees 0.15 per ounce, currency conversion costs, USD to CNY 0.08 per ounce, total cost 139 per ounce, net profit 815, 139, 676 per ounce. For a single 1,000-ounce COMEX contract, that's $6,160 in guaranteed profit. For a 100 contract position, 100,000 ounces, that's $676,000 in profit with virtually zero market risk. This is not speculation. This is not directional betting. This is pure arbitrage, buying and selling the same commodity in different markets to capture a pricing inefficiency. And when arbitrage opportunities this large exist, capital flows to exploit them, violently. Why the gap exists. In an efficient market, arbitrage opportunities get eliminated almost instantly. Traders see the gap, execute the trade, and the price differential collapses within hours or days. This gap has existed for 47 days, and it's widening. Why? Because COMEX can't deliver enough physical silver to close the gap, and Shanghai can't source enough silver from anywhere else to satisfy local demand. We're watching a market dislocation where two prices exist simultaneously for the same commodity because the physical metal can't flow fast enough to equalize them. Think about what that means. The silver market, a globally traded commodity with 150 years of price integration across continents, has fractured into separate Eastern and Western markets with an 11.6% price differential that's persisting for weeks. The December 23, 2024, data. Let me give you the specific numbers from the last 24 hours so you can verify this yourself. COMEX spot price, December 23, 2024, 2 RPM EST, 70.15. Shanghai Gold Exchange spot price, December 24, 2024, 9:00 a.m. CST, Y5 41.20 per gram, converting Shanghai pricing, Y5 41.20 per gram, X31 35 grams per troy ounce, a Y16,135 per troy ounce, Y16,135, 725, USD CNY exchange rate, 78.30 per ounce, arbitrage gap, 78.30, 70.15, 8.15, percentage premium, 11.62%. But here's where it gets interesting. That's the spot price. If you look at forward deliveries, contracts for March 2025 delivery, the gap is even wider. COMEX, March 2025, futures $70.82, Shanghai March 2025, forward 79.45, forward arbitrage gap 8.63. The market is pricing in the expectation that this gap won't close. In fact, it's expecting it to widen. Historical context. The last time we saw a sustained arbitrage gap this large was January 1980. During the Hunt brothers squeeze, COMEX silver hit $48.70 while physical silver in Zurich was trading at $52.30, a 360 gap, 7.4% premium. But that gap existed for only 11 days before COMEX changed the rules, instituted position limits, and forced liquidation. The gap collapsed within 72 hours. This gap has persisted for 47 days. It's larger in percentage terms, and there's no mechanism to force closure because the metal can't physically move fast enough. We're in uncharted territory. The flow data? Now let me show you what's happening to physical inventory. According to CME Group's daily warehouse stock reports, COMEX registered silver inventory, the metal available for delivery against futures contracts, has declined by 43.7 million ounces since November 1st. November 1st, 2024, 316.4 million ounces. December 23rd, 2024, 272.7 million ounces net outflow, 43.7 million ounces in 53 days. That's an average of 824,000 ounces per day leaving COMEX warehouses. Where's it going? Shipping manifests from JP Morgan's vault in New York to Shanghai Free Trade Zone show 34 separate shipments totaling 28.3 million ounces between November 5 and December 20th. That's 64.8% of the total COMEX outflow going directly to Shanghai. This isn't retail investors buying coins. This is wholesale physical bullion flowing from Western vaults to Eastern vaults in 1,000-ounce bar form. The arbitrage trade is real. The flows are documented. The gap is accelerating. The reason Shanghai prices are $8 above COMEX isn't just financial arbitrage, it's industrial panic. China is the world's largest manufacturer of solar panels, electric vehicles, electronics, and 5G infrastructure. All of these require silver, and Chinese manufacturers are switching from just-in-time inventory management to just-in-case hoarding. Let me show you why. The solar sector crisis. China produces 85% of the world's solar panels. The top 5 manufacturers, Longai, Trina, Jinko Solar, Canadian Solar, and JA Solar, have a combined annual production capacity of 520 gigawatts. Each gigawatt of solar capacity requires approximately 310,000 ounces of silver. That's 161 million ounces per year if they run at full capacity. In October 2024, something changed. Longai, the world's largest solar manufacturer, announced they were building a 6-month silver inventory reserve. Not a 1-month buffer, not a rolling 30-day supply, 6 months. For a company producing 80 GDALO annually, a 6-month inventory means stockpiling 12.4 million ounces of silver. At $78 per ounce, that's $967 million tied up in raw material inventory. No CFO allocates $1 billion to inventory unless they're terrified of supply disruption. Trina followed on November 8th, announcing a similar inventory build. Jinko Solar followed on November 19th. By early December, all 5 major Chinese solar manufacturers had announced multi-month inventory expansion programs. Why the panic? 3 factors converged. Factor 1, the Mexico export restrictions. On October 15, 2024, Mexico, the world's largest silver producer at 189 million ounces per year, announced new export licensing requirements for refined silver. The official reason was strategic resource management. The actual reason is that Mexico's new government wants to ensure domestic industrial users have guaranteed supply before allowing exports. The licensing process adds 30-45 days to export timelines and creates uncertainty about approval. Chinese buyers started paying premiums to lock in supply before licenses potentially get denied. Factor 2, the Peru mine disruptions. Peru produces approximately 95 million ounces per year, making it the world's 2nd largest producer. In late October, community protests shut down the Antamina mine, Peru's largest copper-zinc-silver operation. The mine produces 5 million ounces of silver per year as a byproduct. Then, on November 12th, workers at the Uchucchacua mine went on strike over contract negotiations. That mine produces 3.2 million ounces per year. And on November 28th, heavy rains caused flooding at the Palancata mine, suspending operations for an estimated 8 or 12 weeks. That's another 2.8 million ounces offline. In 6 weeks, Peru lost 11 million ounces of annual supply, 11.6% of national production. Chinese buyers saw this and realized if the world's 2nd largest producer can lose 12% of supply in 6 weeks, the supply chain isn't stable, it's fragile. Factor 3, the US-China tech war. In September 2024, the United States added 6 Chinese technology companies to the entity list, restricting their access to U.S. semiconductors, equipment, and materials. One of those companies was Huawei, which is China's largest producer of 5G base stations and telecommunications equipment. Huawei uses approximately 850,000 ounces of silver per year in its 5G infrastructure products. Being cut off from U.S. suppliers triggered a stockpiling response. If you can't be certain of future access, you buy as much as possible while you still can. Other Chinese tech companies observed Huawei's Entity List addition and drew the same conclusion. Hoard critical materials now before access gets restricted. The cascade effect. When the largest manufacturers in an industry start hoarding, everyone else follows. Because if you don't and supply tightens, you're the one who has to shut down production while your competitors keep running. This is the classic prisoner's dilemma applied to industrial supply chains. The rational response to others' hoarding is to hoard yourself. And in China's solar sector, with tight margins and fierce competition, shutting down a factory for 30 days due to material shortages can mean losing customers permanently. So companies that never held more than 30 days of inventory are now building 90, 180-day reserves. And they're willing to pay $78 per ounce instead of waiting for COMEX prices to arrive in 45 days. The quantification. Let's add up the Chinese industrial silver hoarding. Solar manufacturers, 6-month inventory build. 80 million ounces EV manufacturers, 3-month inventory expansion. 12 million ounces 5G equipment manufacturers, strategic reserves. 8 million ounces electronics manufacturers, buffer stock increase. 15 million ounces. Total incremental demand from hoarding, 115 million ounces. This is demand above and beyond normal consumption. This is one-time stockpiling that's hitting the market all at once. And it's all concentrated in Shanghai because that's where these manufacturers are located. They're not buying in London or New York and waiting for shipment. They're buying locally at premium prices to get immediate delivery. That concentrated demand spike is what's driving the $8 premium. The timeline. When does this hoarding end? Not until manufacturers feel confident about supply stability. And right now, every week brings new disruptions. December 5th, Argentine mine strike. December 11th, Australian refinery maintenance shutdown. December 18th, Canadian mine flooding. Each new disruption reinforces the hoarding behavior. Each supply shock makes manufacturers think, we should have bought more. Analysts are projecting this inventory build will continue through Q1 2025 at minimum, potentially extending into Q2 if supply disruptions persist. That's another 60-90 days of elevated Chinese demand driving Shanghai premiums higher. Now we need to talk about why COMEX spot price is $70 while Shanghai physical is $78. Because the answer reveals something fundamental about how the silver market actually works and why it's breaking. What is spot price? When you check silver prices online, you're seeing the COMEX spot price. This is derived from the most active near-month futures contract on the Chicago Mercantile Exchange. But here's what most people don't understand. COMEX spot price is not the price of physical silver. It's the price of a futures contract that can be settled in cash or physical metal at the discretion of the short seller. Approximately 98% of COMEX contracts settle in cash. Only 2% result in physical delivery. That means COMEX price discovery is happening in a market where 98% of participants have no intention of handling physical metal. They're trading contracts, paper, leverage. The paper-to-physical ratio. The Bank for International Settlements publishes data on the notional value of over-the-counter precious metals derivatives. As of Q3 2024, the notional value of silver derivatives was $1.87 trillion. That's the total face value of all futures, options, swaps, and forwards outstanding. Now let's calculate how much physical silver exists above ground. Total estimated above-ground silver, 3.3 billion ounces value at $70 per ounce. $231 billion ratio, $1.87 trillion in paper claims. $231 billion in physical metal, Jordaes 8.1.1. For every ounce of physical silver that exists, there are 8.1 ounces of paper claims. But that's the conservative number. That only includes exchange-traded and OTC derivatives that are reported to regulators. It doesn't include unallocated bank accounts, fractional reserve claims, ETF shares backed by pooled storage, not fully allocated, private forward contracts not reported to regulators, synthetic exposures through equity derivatives on mining stocks. If you include these, estimates from metals analysts put the real paper-to-physical ratio somewhere between 51 and 250.1. Nobody knows the exact number because much of it is privately negotiated and not disclosed, but we know it's massively leveraged. Why leverage suppresses price? When you have 250 paper claims for every ounce of physical metal, and 98% of those claims settle in cash, the price is determined by financial traders, not by physical supply and demand. A hedge fund can sell 10 million ounces of silver on COMEX by selling 2,000 futures contracts. They don't need to own any silver. They don't need to borrow any silver. They just post margin and sell contracts. If enough hedge funds, banks, and algorithmic traders sell futures contracts, the price goes down, regardless of what's happening in the physical market. This is how silver stayed at $15 to $20 per ounce from 2013-2020, despite industrial demand growing 18%, mine supply declining 4%. Central banks buying physical mints reporting record retail demand. The physical market was tight. The paper market was infinite. Paper determined price. What's changed? What's happening now is that physical buyers, especially in Asia, are saying, "We don't care what COMEX says. We need physical metal and we'll pay whatever it takes to get it." When industrial users need silver to keep factories running, they can't accept cash settlement. They can't manufacture solar panels with COMEX futures contracts. They need actual metal. And when physical demand overwhelms the ability of the paper market to deliver, the two prices decouple. COMEX futures can trade at $70 all day long. But if you want 100,000 ounces of physical silver delivered to Shanghai within 30 days, you're paying $78. The paper price has become irrelevant to the physical market. Why Shanghai is different. The Shanghai Gold Exchange operates on a physical delivery basis. When you buy silver on the SGE, you're buying physical metal with mandatory delivery. There's no cash settlement option. There's no unallocated account structure. Every contract represents real metal in an SGE-approved vault, and you can take delivery or roll to the next delivery period. This means Shanghai price discovery is based on actual physical supply and demand, not leverage paper trading. And right now, physical supply and demand are saying silver is worth $78, not $70. The broken thermometer COMEX spot price has become what I call a broken thermometer. It's still giving you a reading, but it's not measuring the right thing anymore. It's measuring sentiment among paper traders, liquidity in futures markets, and algorithmic trading flows. It's not measuring the physical supply-demand balance. If you're a solar manufacturer in China, COMEX spot price is meaningless. It doesn't tell you what you'll actually pay to get metal delivered to your factory next month. If you're a bullion dealer trying to source 1,000-ounce bars, COMEX spot is irrelevant. It doesn't reflect the premiums you'll have to pay to acquire physical inventory. The spot price still functions as a reference point for derivatives trading and cash-settled contracts, but it's lost its connection to physical reality. And when a price loses connection to reality, arbitrage emerges. Capital flows to exploit the gap. And the gap widens until something breaks. We're watching that break in real time. There's another layer to this arbitrage gap that has nothing to do with solar panels or COMEX inventories. It has to do with currency warfare and the slow-motion collapse of the dollar-based monetary system. Let me explain. The dollar standard. Since 1971, when Nixon closed the gold window and ended dollar convertibility to gold, the global monetary system has operated on a pure fiat dollar standard. International trade is denominated in dollars. Commodities are priced in dollars. Central banks hold dollars as reserves. The entire system runs on the assumption that the dollar is the stable unit of account. But over the last 3 years, that assumption has started breaking down. The BRICS revolt. In August 2023, the BRICS nations, Brazil, Russia, India, China, and South Africa, announced they were developing an alternative trade settlement system that would bypass the dollar. This wasn't just political rhetoric. They launched actual infrastructure, the new development bank, BRICS Bank, issuing loans in local currencies, bilateral trade agreements settling in yuan, rubles, and rupees, a proposed BRICS commodity exchange pricing oil and metals in a basket of currencies. Then, in October 2024, Saudi Arabia announced they would begin accepting yuan for oil payments from Chinese buyers. This was the first major crack in the petrodollar system that's underpinned U.S. monetary hegemony since 1974. The message was clear. Countries are actively trying to reduce dollar dependence. And when you don't trust the dollar as a store of value, you seek alternatives. Physical commodities, especially precious metals, become monetary alternatives. The Chinese perspective. China holds approximately $3.2 trillion in foreign exchange reserves, of which roughly $850 billion is U.S. Treasury securities. In yuan terms, those Treasury holdings have lost 12% of their value in the last 18 months due to dollar depreciation against the yuan and declining Treasury prices as yields rose. China's central bank, the People's Bank of China, has been steadily diversifying out of dollars and into hard assets. PBOC gold purchases, 2022, 62 tons, 2023, 225 tons, 2024, 187 tons through November. But gold isn't the only metal they're accumulating. Reports from customs data and free trade zone statistics suggest Chinese state-owned entities are also building strategic silver reserves. While this isn't officially confirmed, China doesn't report silver reserves the way they report gold. Import data tells the story. The premium as currency hedge. Let me show you this another way. From China's perspective, paying $78 for silver isn't expensive if you believe the dollar is going to lose purchasing power faster than the yuan. If the dollar loses 15% of its purchasing power over the next 2 years due to inflation or devaluation, and silver holds its value, then paying an 11% premium today to acquire physical metal is cheap insurance. It's not a trade, it's a currency hedge. And when you're managing hundreds of billions in foreign exchange reserves like China's State Administration of Foreign Exchange does, locking in physical commodities at an 11% premium is reasonable risk management if you're expecting the dollar system to become less stable. The Shanghai Gold Exchange, gold premium. This same pattern is visible in gold. On December 23, 2024, COMEX gold spot, $2,638 per ounce. Shanghai Gold Exchange, $2,682 per ounce. Premium, $44 per ounce, 1.67%. Gold premiums in Shanghai have been persistently positive since June 2023. Before that, Shanghai Gold typically traded at a discount to London and New York because China was selling, not buying. The flip to persistent premiums signals a fundamental shift. China has become a structural buyer willing to pay above-market prices to accumulate physical metal. And this isn't retail investors buying jewelry. This is institutional and state-level accumulation. The endgame. If the currency war thesis is correct, if BRICS nations are preparing an alternative monetary system with commodity backing, then the Shanghai premium on silver and gold isn't a temporary arbitrage opportunity. It's the early stage of price discovery shifting from dollar-denominated Western paper markets to yuan-denominated Eastern physical markets. The West still has larger financial markets, more leverage, and deeper liquidity, but the East has the physical metal, and ultimately physical trumps paper. If Eastern buyers continue bidding up physical prices while Western paper prices remain suppressed by leverage, one of two things happens. Scenario 1, arbitrage traders drain COMEX and LBMA vaults until physical supply in the West runs dry. At that point, Western prices have to rise to match Eastern prices or Western exchanges face delivery failures. Scenario 2, COMEX and LBMA change rules to restrict physical delivery, implement cash settlement, or suspend trading. This would confirm that Western prices are artificial and the real price is whatever Shanghai says it is. Either way, the dollar-based pricing system loses credibility, and the shift toward commodity-backed monetary alternatives accelerates. We're not there yet, but the $8 arbitrage gap is a warning sign that we're moving in that direction. So where does this go? Let me walk through the 3 most likely scenarios and what they mean for anyone holding silver or thinking about entering positions. Scenario 1, the gap closes through COMEX price rise. In this scenario, COMEX prices rise to meet Shanghai prices. The arbitrage gap narrows as Western markets acknowledge physical realities. This is the orderly adjustment scenario. COMEX silver rallies from $70 to $78 over 30-60 days. Shanghai prices stabilize or rise modestly. The gap compresses to 1 to 2, which is a normal level for shipping and liquidity differences. Probability, 40% catalysts that would trigger this. Large institutional buyers entering COMEX futures to arbitrage the gap, bullion banks covering short positions to avoid delivery obligations, momentum traders and algorithms buying breakouts above resistance levels, retail FOMO as price crosses psychological levels, 75, 80. What this looks like, steady price grind higher, volatility increases, COMEX open interest declines as short positions get squeezed out. Physical premiums in North America spike as dealers struggle to source inventory. Scenario 2. The gap persists and widens. In this scenario, COMEX prices remain suppressed around $70, $72, while Shanghai prices continue climbing toward 80-85. The arbitrage gap widens to 12-15. This is the market bifurcation scenario. 2 separate silver markets emerge. A Western paper market trading at one price and an Eastern physical market trading at a significant premium. Probability, 35% catalysts that would trigger this. Continued industrial hoarding in China extending through Q1-Q2 2025, additional mine disruptions reducing global supply, COMEX warehouse inventory dropping below 200 million ounces, major bullion banks refusing physical delivery and offering cash settlement. What this looks like, arbitrage traders make massive profits draining Western vaults. COMEX registered inventory falls toward critical levels, under 150 million ounces. Premiums on physical silver in Europe and North America rise to $6-10 over spot. ETFs like SLV face redemption pressure as institutional holders question whether physical backing exists. Scenario 3, COMEX rule change or delivery failure. In this scenario, COMEX changes delivery rules, institutes position limits, or faces actual delivery failures where short sellers cannot source metal. This is the system break scenario. It's what happened during the Hunt Brothers squeeze in 1980 when COMEX changed margin requirements and restricted long positions to force liquidation. Probability, 25% catalysts that would trigger this, COMEX registered inventory falling below 100 million ounces. A large institutional player standing for delivery on 10,000 plus contracts, 50 million ounces. Multiple bullion banks simultaneously unable to source metal for delivery. Physical premiums in Shanghai exceeding $15 to $20 over COMEX. What this looks like: COMEX announces emergency measures, increased margin requirements, position limits on long holders, restricted delivery months, or mandatory cash settlement. Silver futures gap down 10-20% overnight on the rule change announcement. Lawsuits follow. Physical premiums spike to 20 plus over the now meaningless COMEX price. Price discovery shifts entirely to physical markets in Shanghai, Dubai, and Singapore. The probability-weighted outcome. If I weight these scenarios by probability, 40% chance of 78 plus COMEX silver, orderly rise, 35% chance of persistent 10 plus premium gap, bifurcation, 25% chance of exchange intervention, system break, all three scenarios are bullish for physical silver holders. Even the worst-case scenario, exchange intervention, is bullish because it confirms physical scarcity and shifts price discovery to markets you can access by buying physical metal. The only bearish scenario is if Chinese industrial hoarding suddenly stops, Shanghai demand collapses, and the premium disappears. I assign this less than 5% probability given current macro trends. The timing question. The question everyone asks, when does the gap close? The honest answer is, nobody knows. Markets can remain irrational longer than you can remain solvent, as Keynes famously said. But we have some guideposts. Watch COMEX inventory. If registered silver falls below 200 million ounces, currently 272 million, we're approaching critical levels. Below 150 million, delivery failures become probable. Watch Shanghai premiums. If the gap widens to 12 toward 15, that's a signal the bifurcation scenario is playing out. If it narrows to 3-4, orderly adjustment is happening. Watch industrial hoarding. Chinese solar manufacturers have publicly stated they're building 6-month inventories. That process likely continues through Q1 2025. If they announce they've completed inventory builds, demand from that source eases. Watch currency markets. If the dollar strengthens significantly, it could temporarily reduce Eastern appetite for commodity hedges. If the dollar weakens, it reinforces the currency war thesis and sustains Shanghai premiums. My base case: this gap persists through Q1 2025, potentially widening before it compresses. Resolution happens in Q2 2025, most likely through Scenario 1, COMEX price rise, but with elevated risk of Scenario 2 or 3 if inventory falls faster than expected. The trade setup for traders. The setup is buying COMEX futures or physical silver with a stop loss around $67, 4% below current, and a target of $82.85, 17 to 21% upside. Risk-reward favors the long side. For investors, accumulate physical metal or allocated storage positions. Avoid unallocated accounts and undisclosed fractional ETFs. Accept that you're paying premiums over spot, but recognize those premiums may be the actual market price. For industrials, if you're a manufacturer who needs silver, the message is clear. Secure supply now. Don't wait for COMEX prices to normalize. Shanghai is telling you the physical market is tight, and it's going to stay tight. An $8 arbitrage gap between COMEX and Shanghai isn't a temporary anomaly. It's a structural break in the global silver market that signals the end of 50 years of Western price control through paper leverage. Physical buyers in the East are refusing to accept paper prices determined by cash-settled futures contracts. They're bidding up real metal to prices that reflect actual supply and demand. Meanwhile, COMEX inventory is draining at 800,000 ounces per day as arbitrage traders exploit the gap. At this rate, registered inventory falls below critical levels in 340 days, sometime in late 2025. Either COMEX prices rise to close the gap, or Western exchanges face delivery failures that confirm the paper market is fiction. Chinese industrial hoarding, Mexican export restrictions, Peruvian mine disruptions, and the broader currency war are all reinforcing the same message. Physical silver is more valuable than paper claims on silver. The broken thermometer is still showing $70, but the real temperature is $78, and it's rising. If you're watching COMEX prices and thinking silver is cheap, you're watching the past. The future is already trading in Shanghai. And the $8 gap between past and future is how you measure the distance to the breaking point.